Hey, today I'm going to talk about the concept of a Midco transaction. Midco is a slang term or a terminology for a type of tax shelter transaction. But to set up the discussion for that, let me give you some brief background on what happens when C corporations sell their business. And you may think that this is a topic only for big businesses, but it's not. These Midco transactions, we've seen a lot of small businesses get caught up in these Midco transactions, small businesses organized as C corporations. So typically a C corporation will sell the company either as an asset sale or a stock sale. An asset sale meaning that the C corporation sells the assets inside the business, and then that C corporation has income from the sale of the assets, it has cash that it receives from the sale of the assets, and it eventually distributes that cash to the shareholders. That itself is another taxable transaction, so that asset sale is subject to a double tax. The stock sale, what happens is that the owners of the corporation sell their stock in that corporation to somebody else or some other company, and so they're not selling the assets in the company, they're selling the whole company itself as a stock sale. But before you think that escapes this double tax issue, economically it shouldn't. Because what happens from a tax standpoint is that the inside assets have a deferred tax on them. So any kind of sophisticated buyer would know this, and if they're buying the stock of your company, they would discount the purchase price for that deferred tax. And so one way or the other, if you own a C corporation and you exit, you're either going to pay literally a double tax to the government, or you're going to pay the effect of a double tax by a reduction in your purchase price when you just sell the stock. That is, of course, unless your stock qualifies for a Section 1202 exclusion. But assuming that it doesn't in this particular case, that's where this Midco tax shelter transaction comes in. A transaction that I'm not recommending, but that I wanted to explain here and illustrate that it is being looked at by the IRS and taxpayers are getting caught on it, okay? So a Midco transaction is a tax shelter where the stock of your company is sold to an intermediary C Corp, but they do not discount the price for the built-in gain on the assets. They don't discount the price for that deferred tax. So what I just said earlier, economically, I said any sophisticated buyer would discount your purchase price. But in a Midco transaction, the buyer, this Midco company, doesn't discount the price at all. They either give you full cash, or maybe they give you less cash than the actual full value without the taxes, but they're still giving you more than you would have got if a buyer actually considered that deferred tax that was built into the company. And often these Midco companies that do this are set up exclusively for the purpose, or mainly for the purpose, to avoid tax, just for this kind of transaction. So what happens then is the Midco, after they own the corporation that you just sold them, and they've got this deferred tax bill looming in there, they go ahead and they sell the assets of the company they just bought to somebody else. They presumably get about the same amount that they just paid you for it, because they didn't discount what they paid you. So you're thinking they might be about the same amount. Or more likely there's some difference there that essentially is going to be their fee. But when they're all done, they've left the company with no money. And the reason they've left the company with no money is they've probably used the cash that when they sell the company to somebody else, they probably use that cash through lending and escrow arrangements to give back to you. So they never really even had to have the money to buy it in the first place, this Midco that we're talking about. But what they've done is they've created this holding company. That intermediary bought the stock of your company, then sold its assets, and now presumably is stuck with the liability for the sale of the assets, the final built-in gain, the final tax on the built-in gain of the assets in that company. And then what do you think happens? Well, the Midco then goes and dissolves itself and doesn't ever pay the tax, right? And so the result of this kind of transaction is that the original shareholders of the company who sold their company to the Midco got a price for it that didn't include a discount for the tax. The government never got their tax, and those shareholders think, okay, now I get to walk away from it. Well, the IRS does have tools at their disposal to go after these Midco transactions. And what they would typically do is they're going to look for people or parties in this scenario or in this transaction where they can apply the transferee liability tax rules. And under the transferee liability tax rules, anybody who was a transferee, which could be, depending on exactly how that transaction was arranged, it could be the operators of the Midco, it could be the original shareholders of the original company. So there different parties could be tagged with this transferee liability. But the point is that the IRS is probably not totally helpless here. They're not without tools to go after a transferee for the liability that was just avoided through this transaction. Which party they go after would just depend on the facts. I have a different video on transferee liability, and I'm going to do one that actually uses the specific facts of a case as an example. So look for those videos if you want to know more about this potential problem. But if you have seen anything or you're involved in anything that kind of looks or smells anything like this, then I'd say that's time to do some additional research or investigation, because what I'm raising this to let you know that it is a problem, and the IRS does have tools to go after the people involved in it and pin them with the liabilities. Okay, that's it for now, and I will talk to you guys later. Bye.